Hello everyone, thank you for joining us for our webinar today. My name is Laurel Dobbin and I will be your moderator. Today's webinar is Standards for Accounting and Review Services Update. A few housekeeping items before we get started with our presenters. You'll see your webinar pane in front of you. Please note that the orange arrow will allow you to minimize or maximize the pane. If it's minimized, simply click on the orange arrow to bring it back. Feel free to submit questions in the question box throughout the webinar, and our presenters will handle questions at the end of the webinar as time permits. And now for your audio settings. If you are using your telephone to listen to our webinar, please make sure you select Use Telephone, or if you're listening through your computer speakers, please select Mic and Speakers. If you have the incorrect audio setting, it will actually create an echo sound, so you do want to make sure you pick the correct setting. And then for those of you who wish to qualify for California CE for today's webinar, you must do the following. Use a personal computer, no PDAs, and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions and complete the evaluation survey at the end of the webinar. And now I'd like to introduce you to our presenters. First, we have Stacy Kowalczyk. Stacy is an audit senior manager. She has more than 12 years of audit and accounting experience and focuses on entities in the retail, consumer products, professional services, and nonprofit industries. And we also have Paul O'Grady joining us today. He's an audit partner. He has more than 20 years of experience serving nonprofits, real estate and construction, and distribution entities, and he's an executive committee member of the East Bay Economic Development Alliance. So welcome to both of you. Thank you for presenting today. I'm going to go over the learning objectives and then pass it off to our presenters to get started. During today's webinar, you will review the updated general principles for SSARS engagements. This is sections 60, 70, 80, and 90. Discuss requirements for financial statement compilation, preparation, and review, and identify how clients should work with their accountants throughout the 2015 year. And with that, I'll pass it off to Stacy to begin.
All right, thanks, Laurel. Well, I just wanted to say thank you to everyone again for joining us this morning. Before I get too far into this presentation overview, I thought that this would actually be a good place to point out high level that SSARS 21 essentially supersedes all existing SSARS through SSARS 20. With one exception. So that one exception is SSARS 14, which deals with compilation of pro forma financial information. That SSARS was intended to provide guidance on compiling information to show what effects on historical financial information might have been if a proposed transaction or event had occurred at an earlier date. So an example of that would be like a business combination or a disposition of a significant portion of a business. So as of the present time, as I mentioned, SSARS 14 is currently being redrafted, and when it's done, it's going to be issued as a separate SSARS when finalized. So I just wanted to point that out. With that said, I want to move into our presentation overview. In our webinar today, we're going to take a deeper dive into the 4 critical sections of SSARS 21. The first section, 60, we're going to give updates on the basic financial information for all engagements performed in accordance with SSARS. So now remember I just mentioned that SSARS 21 supersedes all of the existing SSARS with that one exception. So section 60 now gives guidance as a whole with respect to performing these engagements. In section 70, we're going to talk about updates to standards when an accountant is engaged to prepare financial statements. Section 80 will discuss updates to standards when an accountant is engaged to compile financial statements. And section 90 is going to discuss updates to standards when an accountant is engaged to review financial statements. One last note before leaving this slide, in each of these sections we're also going to highlight the key substantive changes from the existing guidance to the new guidance, but we'll also discuss the practical implementations and how how we can help you implement that guidance during the year. All right, so in addition to the new SSARS 21, the Statements on Standards for Accounting and Review Services, or SSARS, as we'll refer to them today, have also gone through a similar clarity project that you know about that the audit standards went through a few years back. So the AICPA's Accounting and Review Services Committee, or ARSC as we'll call it, thought that a similar project for the SSARS would serve the public interest, but would also ensure that literature for audits, comps, and reviews would be drafted using the same drafting conventions. So in terms of just like the look and feel of the new clarified SSARS, some of the clarity drafting conventions include establishment of objectives for each section. So each one of the sections that I just mentioned will have their own objectives. Each one of the sections will also include a definition sections, which would be really helpful. And then the requirements in each of those sections is actually going to be separated from any explanatory material, which will help because it will give separation to what is actually required versus additional guidance to help. And then finally, the drafting conventions are going to include some formatting techniques such as bullet lists that are just going to enhance the readability. So we all know this literature is enough to put any of us to sleep, so the ARCU is being considerate in that respect and hoping that some of that formatting would help keep us awake at night. So I'm happy for that as well.
Okay, and we're going to jump right into our first polling question. Please remember, if you are asking for CE credit today, we ask that you answer 75% of these questions. How much impact do you think the new SARS-21 and codified SARS will have on you? A, I expect them to turn my world upside down. B, some impact. Or C, not sure. I would like to learn more. And just for clarification, we will be sending out a recording of this webinar and the slide deck within 3 days of the webinar, so you will each get a link to that. Okay, the results are coming in. Looks like most of you are submitting your votes, and we'll close the polls in 3, 2, 1.
All right. So it looks like we have the answers in. Well, I'm glad none of you actually nobody said that you expect this to turn your world upside down, so that's good actually. Looks like most of you said that you're not sure yet, you want to learn more, so that's good. You've come to the right place. Hopefully we'll give you some additional information today to help you make your decision. All right. All right, so let's move on to the effective dates of SARS-21. You can see here on the slide that we've delineated essentially like the effective date for all of the sections, which is essentially the same. It's for fiscal year, it's for periods ending on or after December 15th of 2015. So the answer here is really simple. If you engage your accountant to compile, review, or prepare your financial statements, just remember periods ending on or after December 15th of 2015. Now you can early adopt. So for example, if you have a period that's ending prior to December 15th of 2015, you can early adopt, or if you're essentially wanting to have compiled, reviewed, or prepared financial statements in an interim period, you definitely can early adopt this guidance. All right, so with that said, we'll get into Section 60, which is the general principles for all engagements performed in accordance with SARS. Section 60, as I mentioned before, was really designed to help accountants better understand their professional responsibilities when performing these types of engagements. Any guidance in this section has also been incorporated into the latter sections that we'll talk about, 70, 80, and 90. One caveat is that the SARS don't address any responsibilities for accountants to ensure compliance with external legal, or regulatory obligations, for example. So if those things come up, just make sure that you're discussing any of those items one-on-one with your accountant to make sure how they impact you. So the first 4 bullet points on this slide are really principles surrounding ethical requirements, professional conduct, professional judgment, engagement quality level, and things of the like that are really accountant-centric and to some extent internal quality control on part of the CPA firm. So I don't want to spend too much time on these bullets. What I do want to spend a few minutes on is that last bullet point regarding the acceptance and continuation of client relationships and engagements, because I think that's probably what you'll glean the most of importance from this slide. So what's important here is that the accountant, and specifically the engagement partner, is required to assess acceptance and continuation of client engagements by considering several factors. And one of those is the integrity of management, those charged with governance, and also the ability on the flip side of the firm and the engagement team to comply with the relevant requirements. As a condition for accepting engagements in accordance with SSARS, the accountant should also obtain the agreement of management on management's responsibilities in relation to the financial statement. So that's a really important keynote. And just to give you an idea of what some of those responsibilities would be on the part of management that we would be required to obtain are, number one, the selection of the financial reporting framework that's going to be applied in the preparation of the financial statements, the design, implementation, and maintenance of internal control, the prevention and detection of fraud, and ensuring that the entity complies with external laws and regulations that are applicable to its activities. Additionally, management is responsible for ensuring the accuracy and completeness of records, documents, explanations, any other information that's provided that would be used by the accountant to prepare the financial statements. So I want to point out here that if you're a smaller entity and maybe just struggling with some of these responsibilities and what they might mean to you, make sure you engage your accountant in discussions early on, especially the engagement partner, to make sure that you're fully clear on what your expectations would be. One other point before we wrap up this section, under the new standards, the accountant's required to agree upon the terms of the engagements for all the SSARS. The agreed upon terms of the engagement should be documented in an engagement letter or other suitable form of written agreement. So that's a little bit different probably than what you've been used to in the past. The requirement that management sign the engagement letter is actually intended to better ensure that management has essentially read the fine print of the engagement letter and understands and accepts all of its responsibilities that we just discussed. So read the fine print. It's important.
So how should the accountant and management or the client work together with respect to Section 60 of SSARS 21? Well, I think the key with engagement acceptance is that it should be performed in advance. In addition to the webinar today, we'd encourage each of you to discuss the specifics of your engagement one-on-one with your accountant. We want to make sure that there's transparency in the process and that you as our clients get the guidance you need. It's our requirement as accountants to make sure that we not only evaluate the engagement acceptance at the beginning of the process, but throughout that process as well. If facts or circumstances come to light during our engagement that would alter our initial engagement acceptance, we should perform our due diligence to address those matters. And finally, as mentioned, SSARS 21 now requires the use of a formal engagement letter. I think from the perspective of records, the key takeaway here is that the accountant should determine whether the records needed to perform the engagement are complete and accurate. As we will see as we get into later sections, there may be situations where the accountant would request management to correct or fix incomplete records prior to continuing with the engagement. Additionally, throughout the course of the engagement, it's important to note that the accountant is not precluded from advising management on journal entries or other matters that would be needed to make the financial statements more accurate. Finally, on the financial reporting framework, I think this almost goes hand in hand with engagement acceptance. As we mentioned on earlier slides, you and your accountant should be talking and discussing the intended financial framework because it will impact the procedures performed, as we will get into later when we look at the accountant's report. On a final note, keep in mind that SSARS 21 does not include guidance on external legal or regulatory issues. As a result, it's important for management to keep your accountant informed of any of those issues, knowing that additional measures may need to be taken to conform to additional compliance requirements.
All right. Thanks for wrapping up that section. So now we're moving on to Section 70, which is preparation of the financial statements. So this section applies when an accountant in public practice is engaged to prepare financial statements, or what we call non-attest services. And I'm sure that most of you on the webinar today have heard of that term before. It doesn't apply, though, when we're engaged to perform an audit, review, or compilation of those financial statements. So essentially, the accountant can't prepare and then subsequently do a review, audit, or comp. Now, another third-party auditor or accountant could do one of those services, but not both. Additionally, the use of the words accountant in public practice that I mentioned in that last sentence is also important, because if the accountant is not in public practice, then these standards don't apply, and they can't apply these standards. So just important to, to keep note of. Additionally, these standards do not apply when financial statements are prepared, number one, solely for the submission to any taxing authority for inclusion in written personal financial plans, or in conjunction with litigation services that involve pending or potential legal or regulatory proceedings, or in conjunction with business valuation services. So just a few things to keep in mind where the standards, again, don't apply. A couple of other key factors here. As I mentioned a minute ago, an engagement to prepare financial statements is a non-attest service, so it doesn't require determination about whether or not the accountant is independent with respect to the entity that's requesting the service. The engagement to prepare the financial statements does not require the accountant also to verify the accuracy or the completeness of the information provided by management, or otherwise gather evidence to express an opinion or some type of conclusion on the financial statements, or otherwise report on them. So this is a little bit different. You'll hear when we talk about Section 80 and 90 on compilations and reviews, that piece of it right there is a little bit different with respect to Section 70 and the preparation of financial statements. So just keep that in mind as we get later on in the presentation today. So that introduction actually takes us to the first bullet point on the slide here, where the report is not required in an engagement to prepare financial statements. So your accountant is not going to give you any type of report to go with that preparation. Additionally, for bullet point number 2, a statement on each page at a minimum where the financial statements are prepared that no assurance is provided is required. So again, that's going to come as a statement form on the face of the financial statements. So interestingly enough, if the accountant cannot make that statement, we're actually required to issue a disclaimer that no assurance is provided. You might think that that's kind of like a catch-22. It is a little bit unusual, but essentially if we can't label the statements as such, we have to provide this additional disclaimer. Just an example of what that disclaimer may read like: the accompanying financial statements of XYZ Company as of and for the year ended December 31st, 2000X were not subject to an audit, review, or compilation, and accordingly we do not express an opinion, a conclusion, or provide any type of assurance on them. So just to give you kind of a little bit of an idea, that disclaimer would be signed by the accounting firm or the accountant as appropriate, and it would be dated and include the information on the accountant's city and state. So again, if the accountant also cannot provide any assurance, it has the option to issue that disclaimer or to perform a compilation in accordance with Section 80, and we'll talk about that a little bit more in just a minute. On a final note here, if the accountant prepares financial statements that omit substantially all disclosures required by the financial reporting framework that's selected by management, the accountant should be disclosing the omission in the financial statements. If a situation arises where the omission was done with the intent on part of management or those charged with governance to mislead the users, the accountant's not permitted to prepare those financial statements that omit those disclosures.
So we're going to mix it up a little bit here. We know that this topic probably doesn't have all the attendees on the edge of their seats. So in the next slide, what we're going to do is to compare and contrast examples of when Section 70 would apply as opposed to when it would not. The first slide is a simple comparison contrast of the information that Stacy just mentioned. In the most basic sense, this section applies when an accountant in public practice is engaged to prepare financials. And the key term there is prepare financials. As mentioned earlier when Stacy spoke, if the accountant is engaged to perform an audit, review, or compilation, then this section wouldn't apply because those are separate engagements that we'll talk about a little bit later. Section 80 of the standard refers to compilation, Section 90 reviews, and then, of course, the auditing standards will refer to an audit engagement. Additionally, if the accountant is not in the business of public accounting, so is working in private industry per se, he or she cannot practice the standards in Section 70. So the next slide gives us an illustration of services for when Section 70 applies versus when it does not apply. As we can see from this slide, Section 70 applies when an accountant prepares financials prior to audit, compilation, or review of those financials by another accountant. The section also applies when the accountant is engaged to prepare management use financials that are not expected to be used by a third party. Again, as Stacy mentioned, it does not apply when the accountant prepares financial statements in relation to litigation services, or for that matter, business valuation, tax preparation, or the preparation of personal financial statements. So as we can see, there's a clear delineation in the standard as to when 70 and 70 does not apply. Moving on to the next slide, we see that Section 70 also applies when the accountant is engaged to prepare a single financial statement or financial statements with substantially all disclosures omitted, or those instances where the accountant uses the information from the general ledger to prepare financials. And I think that the easiest example of that is when we take the information in the GL out of the accounting system and prepare financials externally, such as in Excel. Also important to note here that it does not apply to drafting financial statement notes, nor does it apply to general bookkeeping services that are provided by the accountant.
Okay, we're moving on to polling question number 2. I'll get this question launched in just a second. Okay, what type of engagement would Section 70 apply to? Drafting financial statement notes, preparing financial statement prior to audit by another accountant, or preparing financial statements in conjunction with litigation services? Make sure you are all paying attention. As a reminder, you are welcome to submit questions in the question pane throughout the webinar, and our presenters will do their best to answer those questions at the end of the webinar. If they don't have time, they will follow up with you afterwards. All right, the votes are coming in. A few more seconds to submit your answer. And we'll close the polls in 3, 2, 1.
All right, so it looks like a landslide. About 69% of you thought that it was answer B, preparing financial statements prior to audit by another accountant. That is actually the correct answer. You know, as Paul mentioned before, when we were comparing and contrasting when Section 70 applies, that was one of the key takeaways on the first slide there that he talked about. So remember, as we mentioned before, Section 70 wouldn't apply if you were just drafting financial statement notes or if you were preparing financials for litigation, for tax regulation, and some of those other items that we mentioned in the first slides. All right.
So as we move out of Section 70, let's just summarize again how the accountant and the client should be working together in this particular area. As we mentioned earlier, when we compared and contrasted, engagement acceptance is really important. It's really important for there to be a clear communication between management and the accountant regarding the nature of the services to be performed and when Section 70 is applicable. And that should take place early in the process. As we can see from Section 70, preparation of financials now is different from compilation of financials. So when you're talking to your client, make sure that, when you're talking to your accountant, should I say, make sure that there's a clear discussion in advance of what the service that is required is going to entail. Section 70, as we mentioned, is also unique in that there's no report provided by the accountant, nor is there any opinion or conclusion reached on the financial statements. So with that said, we've mentioned that the accountant is not required to verify the accuracy of the records. However, we did mention that the accountant does have some degree of responsibility in indicating that no assurance has been provided on the financial statements. I think a practical aspect here for those on the webinar to consider is that many of our clients have banking relationships where the bank will ask for a compilation. So make sure as you discuss with your accountant up front that the appropriate level of service is being provided. And if a bank will accept financial statements under 70, that you've had that discussion with them ahead of time. The one thing we wouldn't want is to provide Section 70 services and then find out that the bank needed a compilation or review. I think the accountant also should be working up front with you to provide guidance on any judgments. For example, if there are alternative accounting policies, discuss those in advance and make sure that both the accountant and you understand any potential impact on the financial statements of the type of service being provided. And finally, it's important for management and the accountant to discuss and really agree on the financial reporting framework and agree upon that ahead of time. Even more important, I think, is that management has a clear understanding of that framework, particularly if the framework is not GAAP. An understanding and conclusion as to the framework to be used will really impact how the accountant works with management to prepare the financials, including requests for information and records to aid in preparation. So make sure you understand that framework, whether it's a tax basis framework or what we call an OCBOA or other comprehensive basis of accounting framework, so that ahead of time, again, there's clear understanding and transparency with respect to what is needed and the services to be provided.
So that wraps up Section 70, and now we're moving on into Section 80, which governs compilation engagements. So on that first bullet point on this slide here, keep in mind this section applies when an accountant is engaged to perform a compilation service. So the emphasis is on the word engaged. So let me give a little bit of history onto that will hopefully make that a little bit clearer. Section 80 of SSARS 21 actually modifies the applicability of the compilation literature. So pre-clarity compilation literature applied when an accountant was either engaged to report on compiled financial statements or to submit financial statements to client or to third parties. So you can see there that there was a couple of options for when those types of services could be performed. And I emphasize the word submit there because in the old guidance, submission was defined as preparing and presenting. So that's kind of interesting actually, because in my mind when I read that, and I don't know about you all, but when I hear that, it kind of seems like that's more similar to what we just discussed and what Paul just discussed a lot of in Section 70. And that really is the gist of the change. So Section 80 of SSARS 21 essentially eliminates the need for the accountant to determine who prepared the financial statements by eliminating that submission requirement and making this section applicable only when the accountant is engaged to perform a compilation service. Under the old guidance, just one other point, if the financial statements were prepared and presented by an accountant to management that weren't intended for any third-party use, those financial statements didn't need to have a compilation report attached to them. So again, that was another difference in the old guidance. So what has changed is that those types of engagements are more defined and covered in Section 70 that we just discussed on preparing financial statements. So with that said, in looking at bullet point number 2 here, one of the key primary changes with this section is that a report is now required for all compilation engagements. So the objective of the accountant in a compilation engagement is to apply accounting and financial reporting expertise to assist management in the presentation of financial statements and report in accordance with this section. So in doing so, the accountant does not provide any type of assurance that there are no material modifications that should be made to the financials in order for them to be in accordance with the applicable financial reporting framework that's selected by management. Because the compilation engagement is not an assurance engagement, it's not a type of insurance engagement, it doesn't require the accountant to verify again the accuracy or completeness of the information provided by management. But the accountant has to be independent of the entity with respect to compilation services. So as a condition for accepting an engagement to perform a compilation with respect to an entity's financial statements, the accountant should obtain the agreement of management and that it acknowledges and understands its responsibility for two main aspects. One, as I mentioned, is the preparation of the financials in accordance with the framework selected. And then number two is management's responsibility to include the accountant's compilation report in any document containing financial statements that indicates that the entity's accountant has performed a compilation engagement on those financial statements. So that's required unless some type of different understanding is reached. So if the accountant, again, Paul's been mentioning a lot about how the accountant should be working with you. In this situation, in terms of what I just mentioned, if we are not satisfied about any of those matters or any of those preconditions for accepting an engagement, then we should discuss that with you, and potentially if any of those changes are not made in order for you to be able to take your responsibility, we shouldn't be accepting the proposed engagement. One other note, just in terms of the compilation engagement services, the accountant is required to read the financial statements in light of the accountant's understanding of the financial reporting framework, and the significant accounting policy is adopted by management to make sure that the financial statements appear to be appropriate in form and free from obvious material misstatements. All right, so as I mentioned on the previous slide, and I want to show you an example here on this slide, the primary, one of the primary drivers, one of the primary changes here was the report. So on this slide that you're looking at right here, this is the old accountant's compilation report. It's a standard 3-paragraph report, says what we did, references the financial statements. In the second paragraph, references management's responsibility, and then our responsibility about what we did with respect to those financial statements. And that we read them, didn't believe that any material modifications should be made. So under the new guidance, to give you an idea, the compilation report will look something like this. So it's a standard, it goes from a 3-paragraph report to just a 1-paragraph report. You'll also see down there at the bottom that it now requires to have the signature of the accounting firm, our city and state, and then the date of the accountant's report. Again, as we mentioned before, this report is in writing. It should include a statement that management is responsible for the financial statements. It should identify the financial statements that have been subject to the compilation services, so the balance sheet, income statement, what have you. Specify the date or period covered by the financials. Include a statement that the accountant performed the engagement in accordance with the SSARS. And include a statement that the accountant did not audit or review the financial statements, nor express any other type of opinion or conclusion or provide assurance on the financials. And then as I mentioned down there at the bottom, it includes the information about the firm, which is different than the previous reporting version. All right, so the next slide is going to be a little bit fun. This section of this slide of the section AV talks about when additional paragraphs to the accountant's standard compilation report are required. So we just talked about the main changes to the basic or the standard report. So in this slide, I'm going to take you through a few key bullet points about when an additional paragraph and or paragraphs would be required. And I think it's important to talk about these things because it's a good refresher for you as the audience if you have any of these types of special facts and circumstances that just kind of give you, a little bit of a heads up or a red light when talking to your accountant early on in the game in terms of recognizing some of these items. So that first bullet point there with respect to the financial statements being prepared in accordance with some type of special purpose framework, the compilation report, the accountant's compilation report in that instance should make reference to management's responsibility for determining that the applicable financial reporting framework is acceptable in the circumstances. It should also describe the purpose for which the financial statements are prepared or refer to a note in the financial statements that contains that information. The accountant's compilation report in this scenario should also include a separate paragraph that indicates that the statements are prepared in accordance with the applicable special purpose framework and states that the special purpose framework is a basis of accounting other than GAAP. So I think Paul mentioned before a typical acronym or way to remember that is some other type of comprehensive basis other than GAAP, so like a cash basis of accounting for an example. The second bullet point when additional paragraphs might be needed is when management elects to omit substantially all disclosures required by the applicable financial reporting framework. So when reporting on financial statements that omit substantially all of these disclosures, the accountant should include a separate paragraph that includes a statement that management has elected to omit those disclosures, a statement that if the omitted disclosures were included, that they might influence the user's conclusions about the financial position, results of operations and cash flows differently than if it were included. And then a statement that the financial statements are not designed for those who are not informed about those matters. The third bullet point there regarding our accountant's independence. So remember I mentioned that with respect to compilation engagements, the accountant is required to be independent. So as we mentioned at the beginning of this section, if the accountant is not independent with respect to the entity, the accountant should indicate that lack of independence in the final paragraph of the accountant's compilation report. If the accountant elects to disclose a description of those reasons of why the independence is impaired, the accountant just should make sure that the detail for the reasons is included in that paragraph. The fourth bullet point there regarding any type of known departure from the applicable reporting framework. So when an accountant becomes aware of such a departure that is material to the financial statements, if the financial statements aren't revised in that scenario or the departure is not disclosed in the notes to the financial statements, the accountant should modify the compilation report to adequately disclose that departure. If the accountant believes that the modification of the report is not adequate to indicate the deficiencies, the accountant should withdraw from the engagement and provide no further services. And that last bullet point there on the supplementary information that accompanies the financial statements. So when we talk about the supplementary information, it could be information that the accountant either takes responsibility for or doesn't take responsibility for in terms of mentioning the supplementary information. And we talk about that in terms of a degree of a responsibility. So whether or not the supplementary information was subject to the procedures applied in the engagement or whether it was not. So in that first scenario, the accountant should include an other matter paragraph in the report that basically states that the information is presented for purposes of additional analysis and is not a required part of the basic financial statements. Additionally, they should state that the information is the representation of management and that the information was subject to the compilation procedures. However, the accountant hasn't audited, otherwise reviewed, or expressed an opinion or conclusion on that information. Now, in the second scenario, when the supplementary information is not subject to the compilation engagement, the first two bullet points that I mentioned before hold true. The accountant still needs to represent that that information is for the purposes of additional analysis only, and it's the representation of management. But it needs to also include another disclosure that says the information was not subject to the engagement, and accordingly there's no expression of opinion or conclusion. So just to give you some ideas here of some additional paragraphs, again, if you have any of these scenarios, talk with your accountant early and have them walk you through what those additional paragraphs might be worded like.
So I think the key takeaway, and I feel like I've a little bit of a broken record on this engagement acceptance and talking to your client slide, but again, it's really, really important that the accountant and the client are communicating up front to ensure that the appropriate level of service is being provided given the client's needs and the applicable standards. Certainly on engagement acceptance, as a condition for accepting the engagement to perform a compilation, the accountant needs to obtain the agreement of management that it acknowledges and understands its responsibility for the preparation and fair presentation of those financials, and for the fair presentation of those financials in accordance with the applicable financial reporting framework. So talk about the framework, talk about the service provided to ensure that whatever level of service that you agree upon is the appropriate one for your needs. Under the old guidance, I think as Stacy mentioned, if financial statements were prepared and presented by an accountant to management that were not intended for use by third parties, those financials did not require or were not required to have a compilation report. What's changed here is that these types of engagements are now not covered in the previous section 70 that we discussed, which covers preparing financial statements. And as such, compilations now require a report. I think it's also important to remember from a records perspective that a compilation engagement is not an assurance engagement. It does not require that the accountant verify the accuracy or completeness of the information provided by management or otherwise gather evidence to express an opinion or conclusion on those financials. So remember, the compilation does not provide the assurance that you would obtain were you to have a review or an audit performed. However, if in the course of the engagement, the accountant becomes aware that records, documents, explanations, or other information, including significant judgments provided by management, are incomplete, accurate, or otherwise unsatisfactory, the accountant should, of course, bring this to the attention of management and request additional or corrected information. So again, similar to the accountant's responsibilities discussed in the previous section 70 on preparing financials. And then I think the final takeaway here, and Stacey went through in considerable detail here, additional paragraphs in the accountant's review report. So the key takeaway here, I think, is that the accountant should have sufficient conversations with management during the planning and engagement acceptance phase of the engagement to determine whether circumstances exist that would lend to such additional paragraphs in the accountant's compilation report. The accountant, of course, should clearly communicate the reporting requirements of these paragraphs and communicate with management early on in the process about expectations and the wordings of those proposed paragraphs if they are required to be included in the report.
Okay, polling question number 3. I'll load the question on your screen here for you. Just a reminder, we will be sending out the recording and the PowerPoint slide deck within 3 days of today's webinar for each of you. Accountants are required to be independent in a compilation engagement. Is that true, false, or you're not sure? Answers are coming in. I think most people are still with us, guys. They're still still retaining the information. Lots of good things to keep in mind from today's webinar. All right. Reminder, if you do want that CE, you'll need to answer 75% of our questions today. All right, we'll go ahead and close the polls in 3, 2, 1.
So this is actually an interesting one. We have 30% of the audience responding true, 50% or 56% of the audience responding false, and 8% not sure. And actually, the answer is the 37%. That is actually a true statement. So accountants are required to be independent in a compilation engagement.
All right, so now we're moving on to our last section of our webinar today, which is section 90 on the review of financial statements. To give you a little bit of a brief history here, the primary change here was that section 90 is a clarity redraft of the pre-clarity literature. I know that sounds very exciting, but what it essentially means is how the accountant performs the review in terms of the scope and procedures, which is essentially the meat of section 90, is substantially unchanged. So remember, a review consists primarily of analytical and inquiry procedures, which is different than what we just talked about in the 2 previous sections on preparing a financial statement or a compilation. Additionally, the accountant's required to read the financial statements and consider whether there's any information that has come to the accountant's attention that the financial statements don't conform to the applicable financial reporting framework. Like Section 90 in the compilation engagements, that second bullet point here on this slide, the accountant's report is going to look a little bit different under SSARS 21. SSARS 21 requires the use of headings in the report, so it'll be a lot like the audit reports that you probably have all seen with the headers that came out a few years ago when audit standards were clarified. Also, the accountant, in the sense of the review engagement, must name the city and state of the issuing office. The letterhead can be used if the office information is not apparent to get that across. And on that third bullet point there, although pre-clarity Section 90 essentially states that emphasis of matter paragraphs are never required, Section 90 of SSARS 21 requires that an accountant include an emphasis of a matter or an other matter paragraph in the accountant's review report in certain circumstances. So that is another change there from the old guidance. So moving on to the next slide, I'm going to give you some examples of what those emphasis of a matter and other matter paragraphs may look like, but just to kind of refresh on what those mean. An emphasis of a matter refers to a matter that's been appropriately presented or disclosed in the financial statements. That, in the accountant's professional judgment, is of such importance that it's fundamental to the user's understanding of the financial statements. An other matter refers to a matter other than those that are presented or disclosed in the financial statements. And again, in the accountant's professional judgment is relevant to the user's understanding, the accountant's responsibility, or the review report. So with that said, let's talk a little bit about some of these examples of these types of paragraphs. So my next two slides includes examples of emphasis of a matter or other matter paragraphs. Now a few of these, particularly the first bullet point and the last bullet point on this slide, with financial statements prepared in accordance with a special purpose framework and reporting a known departure from the applicable financial reporting framework, the inclusion of the emphasis of a matter or other matter paragraph to describe those types of items is very, very, very similar to the compilation engagement that I just went over. So what I want to focus on here is the second and the third bullet point on this slide, and just to give you an example of what those paragraphs might look like in those situations. So that second bullet point is a changed reference to a departure from the applicable financial reporting framework when reporting on comparative financial statements. So again, last year and this year is what's being reported on. So when the accountant's report includes a changed reference to a departure from the applicable financial reporting framework, the review report should include an other matter paragraph indicating the date of the accountant's previous review report, the circumstances or events that caused the reference to be changed, and when applicable, the financial statements of the prior period have been changed, so that's also mentioned. So this is an example of an other matter based on our previous definition on the slide that we went over, when it has not been presented or disclosed in the financial statements during the period under review. That third bullet point there, reporting on comparative financial statements when the prior period is audited. When the accountant's report on the financial statements of the prior period contains a changed reference to a departure, the accountant should include an other matter paragraph indicating the date of the previous review report, the circumstances and events that caused the reference change, and when applicable, that those financial statements have also, of the prior period, have also been changed. All right. Moving on to the next slide. The one bullet point here that I want to discuss is that very first bullet point, the example of the inclusion of the emphasis of matter, other matter paragraph when reporting when management revises financial statements for a subsequently discovered fact that became known to the accountant after the report release date. And when the accountant's review report on the revised financial statements differs from the review report on the original financial statements. If a subsequently discovered fact becomes known to the accountant after the report release date, the accountant should discuss that matter with management and, when appropriate, those charged with governance. And sometimes in those situations, management and those charged with governance can be the same group of people, so just keep that in mind. If those financial statements, so based on that discussion, if those financial statements do need revision, if that's determined, we want to make sure that management addresses how the revisions are going to be made and addresses that matter in the financial statements. If management does revise the financial statements, the accountant should date the accountant's review report as of the later date, or they can include an additional date, so a dual date, in the accountant's review report on the revised financial statements. If the reviewed financial statements have been made available to third parties, we need to do a few things. So assess whether the steps have been taken by management are timely and appropriate to ensure that anyone in receipt of those financial statements is informed of the situation. So including that the reviewed financial statements are not to be used in that case. So if management, again, doesn't take those necessary steps, the accountant should apply the requirements of paragraph if the conclusion on the revised financial statements differs from the conclusion on the original financial statements. And if that's the case, there should be 3 additional items that are disclosed in an emphasis of a matter paragraph. Those should be the date of the previous report, the previous accountant's review report, the description of the revisions, and the substantive reasons for those revisions. The second and the third bullet point there regarding supplementary information and required supplementary information for the financial statements. I don't want to take too much time to get into examples of these here because they are very similar to what we just went over in the compilation and review section, in the compilation section in section 80.
So as we wrap up the review of financials, the review of financial statements section, the important thing, of course, on engagement acceptance is similar to engagements performed under section 70 and 80. The accountant should agree upon the terms of the engagement with management or those charged with governance as appropriate. The agreed upon terms of the engagement should be documented in an engagement letter or other suitable form of written agreement, and should include the objectives of the engagement, the responsibilities of management, the responsibilities of the accountant, and the limitations of a review engagement, identification of the applicable financial reporting framework for the preparation of the financial statements, the expected form and content of the accountant's review report, and of course a statement that there may be circumstances in which the report may differ from its expected form and content. Important to note that the accountant should not accept a review engagement if management or those charged with governance impose a limitation on the scope of the accountant's work in terms of the proposed review engagement, such that the accountant believes the limitation will result in the accountant being unable to perform review procedures to provide an adequate basis for issuing the review report. From a records perspective, as we know, a review consists primarily of inquiry and analytical procedures, and if during the course of performing those review procedures, the accountant becomes aware that information coming to the accountant's attention is incorrect, incomplete, or otherwise unsatisfactory, the accountant should request that management consider the effects of those matters on the financial statements and communicate the results of its consideration to the accountant. Additionally, they should consider the results communicated to the accountant and whether such results indicate that the financial statements may be materially misstated. Finally, with respect to modifications of the accountant's review report, I think the key takeaway here is that the accountant should have sufficient conversations with management during the planning phase of the engagement to determine whether circumstances exist that would lend to an emphasis of another matter paragraph. And again, the key here is communication up front among management and the accountant to ensure that any supplementary paragraphs or emphasis paragraphs are clearly discussed, considered, and communicated early in the process. And with that, I think that is the end of the first part.
Yes, and we have polling question number 4, our final polling question. We'll get that loaded up on your screens. The engagement acceptance process in Section 90 for reviews is similar to that of Sections 70 and 80. Is that true, false, or you're not sure? We have had some questions coming in throughout the webinar, and we'll get to some of those in a couple of minutes, but you're free to submit those questions up until the very end, and we will follow up with you afterwards if we can't answer them during the webinar. All right, votes are coming in. And give it a few more seconds for those of you who haven't submitted your answer yet. And we'll close the polls in 3, 2, 1.
And we have a landslide with the correct answer, which is true. The engagement acceptance process in Section 90 for reviews is similar to that in Section 80.
Great. We ended on a good note there, guys.
I think, we've got a couple of minutes for questions, and then we'll follow up with any questions we don't get to, we'll follow up with. One of the ones that I think we have about 6 questions, and 5 of the 6 relate to independence. So I'm going to let Stacy chat a little bit about the polling question on independence, where there was certainly a disparity of agreement on the particular answer.
Yeah, that's right. So it looks like a few of the questions are coming in and just want to clarify whether or not you need to be independent with respect to compilation services. And a second question came in regarding why we can still have a report that essentially indicates that we're not independent. So the additional paragraph that I mentioned. So yes, you did hear it correctly. The firm does need to be independent to perform the compilation. What's interesting is that in the example that I showed you of the compilation report, the revised compilation report, it's interesting in the title that it doesn't say independent accountant's compilation report. And so therefore the guidance indicates that if there is any type of independence impairment, that it's just considered in an additional paragraph in the final paragraph of the accountant's compilation report. So essentially to answer the question, yes, you still could have an independence issue, but it does need to be disclosed. The facts and circumstances of it do need to be disclosed in the report. All right, so we had another question about, this was a Section 70 question. It indicated that we referred to a disclaimer of opinion if the accountant was unable to indicate on the prepared financial statements that no assurance was provided. So that's correct. So essentially in the preparation of the financial statements in Section 70, if the accountant can't essentially label on each one of those financial statements that no assurance is provided, they are required actually to issue a separate disclaimer opinion, and it looks almost like a little mini report. I know I just read the example to you, but it's just a little mini paragraph that basically indicates the disclaimer of opinion and is signed by the accountant, including the date and the firm. So yes, that is, just to clarify, that is the requirement.
We have another question here. It says, can we safely assume that if we engage our accountant to compile our financials, that there will now always be an accountant's report under the new standards? I believe you said under the old standards an accountant could prepare and present financial statements as long as a third party would not be using them without a compilation report. And yeah, that's actually true. Under the new standards, if you are engaged to perform a compilation, that compilation will be accompanied by a report now.
So we have another question here about Section 70 and whether or not this would apply to a CPA who prepares information for submission to HUD. Hopefully I got that question correct. And the only thing that I would caution you on there, though, is that that's a regulatory, that's almost like an external, that is an external regulatory requirement. When we mentioned in Section 70, there were some limitations on preparing financial statements in accordance with requests from legal, regulatory, and tax regulations. So you want to just, make sure in that specific situation that the information that you're preparing, that the grantor or HUD in this case would actually agree to that type of service to prepare the financial information for whatever it was. I'm not really sure in this question. It doesn't give a specific, what type of information. But most of the times when you have any of those types of regulatory agencies, it will make clear what you can and what you're allowed to engage in a CPA firm to do, whether it's an audit, compilation, or financial statement preparation. So this one is that's a great question. It's sort of a one-off situation that we'll probably want to talk about, a little bit further one-on-one.
Great. Well, thank you both. I think we've run out of time. Thank you for answering those questions. Again, if you submitted a question during the webinar that we didn't get a chance to answer, our presenters will follow up with you afterwards. You'll find the presenters' contact information on your screen now. Please feel free to reach out to either one of them if you have further questions. And a reminder, the webinar recording and the PowerPoint slides will be sent to each of you within 3 days of today, so you'll have that for your reference as well as to share with colleagues. And we'd like to thank you all for joining us today. Thank you to Stacy and Paul for your expertise and sharing it with everyone. I hope you all have the wonderful rest of the day and that you join us on a future Armanino webinar soon. Thank you.